So the idea to get profitable is two things. Number one, you have to increase your risk to return ratio and or increase your win rate. Okay, simple as that. So how do you do that? Let's take a look right now. So if having a low win rate is your problem, what are the reasons and what can you do about it? Now, first of all, let me define what's a low win rate. Okay, some people think a win rate of below 70% is a low win rate. No. In trading, I can tell you that a low win rate is anything below 45% consistently. Okay, there are many very successful traders that make tremendous amount of money with a win rate of 45 to 50%. So that's fine. But if you get less than 45%, like below 40%, then you're not that profitable. So you want to always aim for at least a win rate of 45% or more. Again, 50 to 60% is fantastic. So if you get a low win rate consistently, why? Here's a very simple reason. Oftentimes it's because traders trade against the trend. That's a very common reason why you are the odds are against you. Okay, remember that if you enter the market randomly, you toss a coin, heads you go long, you buy, tails you go short, you sell, you should be right half the time, right? So if you're right less than half the time, it's because you're going against random odds, because you're going against the trend. So again, what's a trend? For example, you can see that Facebook is on a very strong uptrend, and you can read the trend by looking at the moving averages, right? I've taught this in my previous videos. When the price is above the moving averages and the moving averages are sloping up, it's a very clear uptrend. So on an uptrend, you always want to go long. You want to buy, because on an uptrend, the statistical probability is that prices will go higher. Okay, it's kind of like a river current, right? The river is flowing north, you want to swim north, right? If you swim south, highly likely you're not going to make it, okay? So the biggest mistake people make is they short the market, they sell on an uptrend. Okay, chances are you're going to get it wrong most of the time because the trend is going up. You don't sell on an uptrend. Okay, at the same time, when it's on a downtrend, what's the probability? The probability is that prices will go lower and lower, right, based on statistical odds. Okay, so the current is flowing south. You want to swim south. You want to sell. You want to short. You don't want to go long. So again, if you buy, like look at GE. GE has been on a downtrend for many months. And many people want to catch the bottom, right? So they are buying, hoping it's the bottom, right? And they're going to die because you're buying on a downtrend, chances are you're going to lose money, right? Same thing if you are selling on an uptrend, okay? Now, but some people say, Adam, on an uptrend, I buy, right? Like what you said, I buy, but I still lose money. So it could be one reason because you buy on an uptrend, but you buy when the price is overbought, when it's overstretched, right? When the price is too far from the moving average, what happens? It tends to snap back to the moving average. It's like a pendulum, right? So a lot of times when people buy on the uptrend, they buy too late. For example, they buy somewhere there, okay? They say, oh, it's going up, they buy here. And what happens after they buy? Boom, goes down and hits their stop loss over here, and they get stopped out and it moves higher. Ah, my God, So you should be buying somewhere here. When it makes a dip on the uptrend, buy it when it's near the moving averages, not buy it when it's overbought, right? Here's another example where, people, they say, oh, the price is going up, and they say, I'm going to buy there. What happens? Boom, it comes down. The moment they buy, hits their stop loss, they're out. Because they buy when the price is overbought. At the same time, again, on a downtrend, you want to go short. You want to sell on a downtrend, okay? But sometimes I sell on a downtrend, I still lose money, right? Because you sell when the price is oversold. Right? So for example, imagine that the price goes down here, and you say, okay, I'm going to sell. It looks like it's going down, they sell. Once they sell, what happens? Boom, it goes up. It hits their stop loss, right? Because when the price is too far from the moving average, it's oversold, it's like a rubber band, snaps back to the moving average. So when you're selling on a downtrend, you always want to sell when it's near the moving average. So you sell somewhere there. You sell somewhere here when it's bouncing off the moving average, right? So you must know when to enter at the lowest risk point, and that's what we teach in our programs. Another common mistake people make is that they buy just below a resistance level, right? So it could be on an uptrend like that, uptrend, but they did not see there's a strong resistance. So they buy, boom, here's a resistance, bam, goes down, they lose money. And say, why am I so unlucky? It's not luck, it's skill, all right? Similarly, people may short on a downtrend, but they don't realize there's a strong resistance or strong support. Support, resistance, right? So goes down, they say, okay, I'm going to do a short, they sell, goes a bit down, boom, it hits the support, bounce up, they lose money. Right? These are the typical reasons why you've got a low win rate, because you're not entering at the best time. Okay, so that's the first thing that you have to watch out for, guys. Now, another reason for low win rates is because traders tend to take low quality trades. In other words, they take trades where it's not a high probability. Okay, and a very common reason is because of impatience, right? A lot of traders, they're very impatient to take a trade, so they're trigger happy. The moment they see something that looks like a trade, even though it doesn't meet the rules, exactly, it's okay, let's bend the rules a bit. It's okay, let's just take it, right? Or they're bored, right? And to them, trading is a way of entertainment and excitement. And I always tell people that good trading should be boring. If you're excited by your trading, that's not good. If you want excitement, go to Universal Studios, go to Dreamworld, go to Disneyland, right? Trading is not for excitement. Trading is for making money consistently, right? Executing trades. So if there are no trades to take on a certain day or 2 days or 3 days, don't take any trades. Only take high quality trades. So for example, you can see that, right, if you are on my trade alert service or you follow my trades, I only take very high quality trades with multiple level of confluence patterns. In other words, when all the stars are aligned, I take those trades. So quality trades over quantity trades. For example, these were some of my trade alerts this month, and you can see that this was LLI, right? I sent this trade alert as well as PII. Okay, so I sent these trade alerts this month, okay, and take a look at why I send those trades. So that was the first one, PII, and the trade alert came out, let me see on which day, on this day, that's right, on the, somewhere about the 10th of November, that's right. So I took a trade here because I saw that it's on a very clear uptrend, so I wanted to go long, I wanted to buy, and you can see that over here, the price was bouncing off the moving average, bouncing off the 20 moving average, okay? So that's not only the reason why I bought. Besides bouncing off the 20 moving average, you can see that this is a Fibonacci retracement level. Okay, so this is A to B, right? That's the impulsive wave, and this is a corrective wave, which is exactly at 61.8% Fibonacci level over there, right? So in other words, this point which I entered by the way on this this candle over here. I entered on this candle, waiting for the confirmation of the bounce. So why did I enter? Because it found support at the moving average plus the Fibonacci level. So it's double confirmation. Plus you can see that the stochastics over here is oversold, telling us the price is oversold, it's going to bounce up. It's on an uptrend. So this is what I call a high quality trade. When all the stars are aligned, highly likely it's going to go in my favor. Again, it's not 100%, but I just have to be right more than 45% of the time. 50% of the time, I'm making a lot of money. Okay, the next one was PLII. This was another one of my trade alerts, and you can see, again, I entered, let me see, where did I enter? I entered, I believe on this day over here. That's right. So again, it was bouncing off the moving average. I waited for a confirmation candle to take the trade. It's bouncing off the 20 moving average support, plus it's a 61.8% Fibonacci level, plus again stochastics is oversold. So these two trades, PII and LLI, both have the same pattern, right? So when you take trades with high confluence, you get very high win rates. Okay? So that's how you get a high win rate. Now, what if your problem is a low risk to return ratio? In other words, what if your average losses are bigger than your average wins? What's the reason why? So again, these are common reasons why. Okay? So first reason why this happens is probably you take profits too quickly. And this is a very common mistake that many traders make. So the moment they enter a trade, okay, and it makes a bit of money, they're afraid of losing that money. So quickly they say, okay, let me take that profit. So they think there's nothing wrong with taking a profit. There is something wrong if you take profits too quickly. When you do not allow the trade to maximize its potential, you get very small wins. And when you get small wins, they are not enough to cover the losses that will come eventually. Does that make sense? Okay. Another reason is because you hold on to losing trades too long. Okay. You take profits too fast, you hold losing trades too long. And why does that happen? Well, one reason is some traders do not put a predetermined stop loss. I had someone who once told me, Adam, real men do not put stop losses. Well, I can tell you he's out of business now. He's bankrupt, okay? So when you enter, you must have a fixed stop loss. So so when you do that, you predetermine how much you're going to lose when you're wrong. Okay, so again, I always limit my risk to 2% of my capital, which is an R of 2%. Okay, so always put a predetermined stop loss. Now, some people, what they do is, say it's going up, right? And they put a buy order here, and they place a stop loss somewhere here. Okay, but when it goes down, they say, I don't want it to hit my stop loss. No, I don't want to lose my all. So what do? They will say, okay, let me give it more room. They'll shift their stop loss down and say, okay, give it a bit more. And it goes down. Oh my God, it's going to hit my stop loss. Shift my stop loss down again. Oh my God, it's going down, right? And eventually what happened? When it eventually hits their stop loss, instead of losing 1 R, they lose 4 R or 5 R. And that one loss can wipe out many wins. Okay? So never ever shift your stop loss down if you're going long, or shift it up when you're going short. Next, one of the most common mistakes people make is to average down their losers. So not only do they not have a stop loss, but when the price is going down, what do? Right? They buy more to average down the price. They think they're Warren Buffett, right? Now, that's what Warren Buffett does. And there's nothing wrong with that, as long as you are an investor, not a trader. There's a difference. As an investor, you're holding for the long term. You're holding for many, many years. And for investors, you only buy defensive, predictable companies. You do not buy cyclical stocks. You do not buy momentum growth stocks, right? So that's the wrong time to apply that strategy, okay? And so why do many traders do this? Why do they shift their stop loss? Why do they not have a stop loss? Why do they average down their losers? Here's the irony, because they are afraid of losing money. And in the market, the more you are afraid of losing money, the more you're afraid of taking a loss, the bigger losses you will have and the more money you will lose. Okay, so always remember that. Never be afraid of taking a loss. To me, trading is like a business. When I have a win, it's my sales revenue in a business. When I have a losing trade, I don't feel bad. It's part of the game. A losing trade is my cost of goods sold. Okay, so when I have a win of 2R, right, I have a loss of 1R, sales minus cost, I still have a profit of 1R. And that's a fantastic business, right? Another reason why many traders are not profitable is because they have inconsistent risk per trade. What it means is they keep changing the risk they take for each trade. For example, they're more confident, they risk more. They are less confident, they risk less. And this always leads to inconsistent results. So I'm here to tell you something. Even if your trading system has a good win rate and your trading system has a good risk to return ratio, you can still end up losing money if you keep changing your risk per trade based on your emotions. All right. So let me give you an example of what I'm talking about. So let's imagine that there's a trading strategy with a win rate of 60%, okay, and a risk to return ratio of 1:2. Now, is that a good trading strategy? It's not bad, right? In fact, this trading strategy will make you a lot of money. But there are some people who learn this strategy but lose money. Let me explain why. Let's imagine at the beginning, they decide to risk 1% per trade, right? So they risk 1% of their capital on each trade. Now, you have to watch my video on position sizing to understand how to calculate the number of shares to buy when you risk 1% per trade, okay? So let's imagine this person starts trading and they get 5 wins in a row, right? Their first 5 trades are wins. Now, remember, every time you lose 1%. You win 2%, right? It's 1-2. So with 5 wins, they get 2%, 2%, 2%, 2%. So their total return is 10%. Now, what happens to most people after they get 5 wins in a row? That's right, their head becomes really big. They get too confident. They say, you know what? I'm fantastic. So I'm going to risk more money so I can make even more money. So what do? Right, they risk, for example, 5% a trade now because of their confidence. Okay, so they buy more shares, they risk more. But they forget that after 5 wins, guess what? Losses will come. You can't win all the time. You have wins and losses, right? And say after the 5 wins, they get 4 losses in a row. So remember, the wins come in a row, losses can come in a row. And but because now they risk 5% of their capital, what happens? Each loss is 5. And they get 4 losses, that's a 20% loss. So what happens? They made 10%, they lost 20%, now they are down 10%. Okay? So even though they had more wins than losses, they are still losing money. Okay? And what happens after 4 losses? That's right, they lose their confidence. Oh my God, all right, let me risk less because I'm scared. So now they go back to risking 1%. And what happens? Then the next trade becomes a win. But this time, because they risk 1%, a win is only 2%. So they make 2%. So plus 10 minus 20 plus 2 is what? Right? Is minus 8%. So after doing 10 trades, they are down 8%. But notice they had 5 plus 1, they had 6 wins and 4 losses. So the win rate is 60%. So there's nothing wrong with the win rate. The risk to return ratio is risking 1 to make 2, but they're still losing money. You understand? So traders lose money because they increase their risk per trade after a series of winning trades because of confidence, and the losses come wipe them out. Okay? Or they start to reduce their risk per trade after a series of losing trades, and when the winning trades come, it's not enough to cover for the losing trades. Another reason why traders lose money is because they judge the performance of their strategy on a small sample of trades. So they may learn a good trading strategy, but for some reason, when they first start trading, their first 10 trades or first 20 trades did not do as well as they expected. So what happens to them? Okay, they lose confidence, right? And so they abandon the trading system, or they find a new trading system, or they say, okay, let me not trade stocks, let me trade Forex. Let me not trade Forex, let me trade options. So they keep going around in circles, right, in search of the holy grail, a system that wins all the time, that will win in every 5 or 10 trades. It doesn't exist. That's why most traders spend all their money buying all the trading courses, reading all the books, going around in circles and never making money because they do not stick to one strategy enough to have enough trades to make it profitable. Okay? Very important. So with that, let's now summarize everything we've learned in this video. The 7 reasons why traders are not consistently profitable. Reason number 1 again, because their strategy has a low probability of winning. Their strategy has got no edge because again, they're trading against the trend, or they're buying when it's overbought, selling when it's oversold, buying at resistance, selling at support, right? Second reason, they take low quality trades, right? They go for quantity instead of quality because they are bored and impatient. Number 3, they've got a low risk to return ratio. When they lose more, they win less. Why? Fear. Fear of taking a loss causes them to hold on to losers too long and take profits too quickly. Number 4, well, it's related. Number 4, taking profits too quickly and taking large losses, right? So that's all related. Sorry about that, right? Okay, number 6, inconsistent risk per trade. Constantly changing how much they risk, right? When they're confident, they risk more. Lose comes, they lose less. So as a result, the statistics are all out of whack. And the last reason why traders lose money is because they do not stick to a consistent trading strategy. They keep changing strategies, adding new indicators, right? Changing trading Forex to stocks, to options, and switching around and never staying with a strategy long enough to master the strategy. Okay, so I hope you understand it, guys. And with that, if you would like to watch more videos, you can subscribe to my channel. If you'd like to find out more about my online professional Forex and stock trading courses, do go to piranhaprofits.com. For our live training courses in Asia, do visit wealthacademyglobal.com. This is Adam Khoo, and may the market be with you.